On the morning of October 31st, 2011, an assistant treasurer in MF Global's Chicago back office sent an email confirming a transfer of approximately $175 million out of the customer segregation account and into the firm's housebroker dealer account. By that afternoon, the reconciliation showed a hole. The figure that would eventually be quantified at roughly $1.6 billion in missing customer money. The funds were gone before anyone in the room said the word shortfall aloud. What this episode examines is not why the money was taken. It is how a regulated futures commission merchant, operating under one of the oldest and most explicit protective rules in American finance, was able to move customer money into proprietary accounts at all. The answer is not a single fraudulent act. It is a structural failure in the boundary between customer property and firm property, a boundary that the law treats as absolute and that MF Global's liquidity crisis converted into something porous. To understand what failed, you must first understand what was supposed to hold. The mechanism at the center of this case is customer segregation. In the United States, a futures commission merchant, an FCM, is a firm that accepts orders to buy or sell futures contracts and accepts money from customers to margin those positions. The Commodity Exchange Act, dating in its core protections to the 1930s, imposes a requirement that is structurally unlike almost anything in banking. Customer funds held by an FCM are not the firm's funds. They never become the firm's funds. They must be held in accounts titled to reflect that they belong to customers, segregated from the firm's own house money, and the firm must at all times hold in segregation an amount at least equal to what it owes its customers. This is the segregation requirement, codified at Section 4D of the Commodity Exchange Act and implemented through Commodity Futures Trading Commission regulations. The principle is simple to state and was, for decades, treated as inviolable. A customer who deposits margin with a futures broker is not an unsecured creditor of that broker. The customer's money sits in a legally distinct pool. If the broker fails, the customer's money is supposed to be there, untouched, because it was never the broker's to spend. Consider what segregation accomplishes structurally. In an ordinary bank, your deposit becomes the bank's liability, and the bank lends it out. You are a creditor. In a properly segregated FCM account, the customer money is held in trust. The firm is a custodian, not a borrower. The distinction matters enormously in a failure scenario because trust property does not enter the general bankruptcy estate to be divided among all creditors. It is returned to its owners first. Now, the rules were not absolute in the sense that the cash had to sit idle. Regulation permitted FCMs to invest customer-segregated funds in a narrow, conservative list of permitted instruments: United States Treasury securities, municipal securities, money market funds. The governing provision, CFTC Regulation 1.25, set out what an FCM could do with customer money while still treating it as segregated. The investments had to be safe and liquid, and critically, the firm had to maintain segregation at all times, meaning the value of what it held for customers could never fall below what it owed them. There was a second mechanism that becomes essential to this story: CFTC regulation. 30.7 governed funds held on behalf of customers trading on foreign futures exchanges. These were the secured amount accounts, also referred to as the 30.7 accounts. They covered customers trading futures abroad, and they carried their own protective requirement, structurally parallel to domestic segregation, but operating under a separate calculation. So, The legitimate architecture looked like this. Customer money flowed into segregated accounts. The firm could invest that money only in permitted instruments. The firm calculated, every business day, two numbers: the amount it was required to hold in segregation and the amount it actually held. The second number had to equal or exceed the first. The difference, when the firm held more than required, was called the excess segregated funds. That excess belonged to the firm. It represented the firm's own capital that it had chosen to keep in the segregated accounts as a buffer. This excess is the seam. It is the one place where firm money and customer money sat in the same account structure, distinguished only by the daily calculation. The firm was entitled to withdraw its own excess. It was never entitled to withdraw below the line that represented customer property. The entire integrity of the system depended on one operational capability. The firm had to know, accurately and in real time, where that line was. It had to be able to compute, at any moment, how much of the money in the segregated accounts was its own excess and how much was the customer's. As long as that computation was reliable, the firm could draw down its excess freely and never touch customer property. When that computation failed, the boundary failed with it. That is the structural setup: a trust obligation, a narrow investment permission, a daily two-number calculation, and a buffer of firm money sitting inside the customer account structure. Now we examine how MF Global's liquidity crisis collapsed all four into a single $1.6 billion failure. To reconstruct the architecture of the failure, begin with what MF Global had become by 2011. The firm was a global broker-dealer and futures commission merchant. Under leadership that had arrived in 2010, the firm pursued a strategy of growing its proprietary trading and its balance sheet, moving beyond the lower margin business of executing customer orders. Central to that strategy was a large position in European sovereign debt. The instrument was a repurchase agreement structured as a repo-to-maturity transaction. Understand this carefully, because the accounting treatment of the trade and the cash demands of the trade diverged, and that divergence is what drained the firm. In a repurchase agreement, a holder of securities sells them for cash and agrees to buy them back later at a slightly higher price. Economically, it is a collateralized loan. In a repo-to-maturity, the repurchase date is set to coincide with the maturity date of the underlying securities. MF Global bought European sovereign bonds issued by countries including Italy, Spain, Belgium, Portugal, and Ireland, and financed them through repo-to-maturity transactions. Here is the accounting treatment that mattered. Because the repo terminated at the same moment the bond matured, the firm took the position that it had, in substance, sold the bonds. Under the applicable accounting standards, the transaction qualified for sale treatment. The bonds came off the balance sheet. The firm recognized the net interest spread as earnings. From an accounting standpoint, MF Global was no longer exposed to the bonds. It had sold them. But that is not what the cash demanded. The repo counterparties required margin. As the European sovereign debt crisis intensified through 2011, the market value of those bonds fell and the perceived risk rose. The counterparties issued margin calls. They demanded more collateral against the financing. And these margin calls had to be met in cash, immediately, regardless of how the trades were treated for accounting purposes. So the firm faced a divergence that defines this case. On its income statement and balance sheet, the European sovereign position was a completed sale generating profit. In its treasury operations, the same position was a relentless consumer of cash, draining liquidity every time a counterparty marked the collateral down and called for more. The record shows that through October 2011, the firm's liquidity position deteriorated rapidly. There were additional pressures. On October 24, 2011, Moody's downgraded MF Global Holdings. On October 25th, the firm reported a quarterly loss. On October 27, the firm's credit rating was cut to junk. A ratings downgrade to junk triggers a cascade. Counterparties demand more margin, clearinghouses raise requirements, lenders pull lines, customers begin to withdraw. By the final week of October 2011, MF Global was a firm with a severe and accelerating cash shortage. Its proprietary obligations, the margin calls, the clearing requirements, the operational funding needs of the broker-dealer exceeded the cash it had available in its house accounts. This is the moment where the seam came under pressure. The firm had a large pool of customer money sitting in segregated accounts. Mixed into the same account structure was the firm's own excess. And the operational systems that were supposed to keep the boundary precise were, the record establishes, not adequate to the volume and speed of the cash movements the crisis demanded. The mechanics of the shortfall, as the public record establishes, worked like this. Step 1. The firm's house broker-dealer accounts ran short of cash to meet proprietary obligations. The treasury function needed to move money in to cover those obligations. Step 2. Transfers were made out of customer-segregated and secured accounts into the firm's house accounts and to meet the firm's own obligations, including obligations to its own counterparties and affiliates. Some of these transfers, in a functioning system, would have represented legitimate withdrawals of the firm's excess. But the firm did not have reliable, real-time visibility into how much excess actually remained. Step 3. As the transfers continued and the customer accounts came under pressure from both the firm's withdrawals and from customers themselves liquidating positions and demanding their money back, the cushion of firm excess was exhausted. Once it was exhausted, every additional dollar moved out of those accounts was customer property. Step 4. The firm continued to move money out. The CFTC's enforcement action established that MF Global used customer-segregated funds, including funds in the 30.7 secured accounts, for the firm's own purposes, and failed to maintain the required segregation. By the end, the deficiency in customer accounts reached approximately $1.6 billion. The CFTC's complaint and the resulting consent order are explicit on the legal character of what occurred. The order found that MF Global, by and through its employees, unlawfully used customer-segregated funds to support its own proprietary operations and the operations of its affiliates, and that it failed to hold sufficient funds in segregation to meet its obligations to customers. The firm violated the segregation requirements of the Commodity Exchange Act and CFTC regulations. Note the structural point. The transfers were not, individually, a series of dramatic heists. They were treasury movements of the kind the firm made routinely, drawing on what it believed, or treated as if it believed, was its own excess. The failure was that the firm kept drawing after the excess was gone, because the systems that defined the boundary could not keep pace, and because the liquidity pressure was such that the money had to come from somewhere. The customer money was the largest pool of liquid cash within reach, and the operational and legal wall that was supposed to make that pool untouchable did not in the final days. Hold. This brings us to the detection question. Customer segregation is one of the most heavily monitored requirements in the regulated financial system. Every business day, the FCM computed its segregation. The firm's own back office produced these statements. The CFTC and the firm's designated self-regulatory organization, the CME Group, acting as the firm's designated SRO, received segregation reporting. There were auditors. There was an entire verification chain built specifically to prevent the use of customer money for firm purposes. So, how did roughly $1.6 billion move out without the system catching it in time? The answer is that the verification chain was built around the daily segregation report, and the daily segregation report was only as reliable as the data feeding it. The first structural weakness was timing. The segregation calculation was a daily computation, performed and reported after the close of business for the prior day. It was a snapshot, not a continuous monitor. Money could move during a trading day, and the deficiency would only surface in the next day's reported numbers, if the numbers were computed correctly. The second weakness was the reliability of the firm's own records. The verification chain relied on the firm to accurately report its segregated balances and its segregation requirement. Regulators and the SRO checked those reports, but the inputs originated inside the firm. When the firm's treasury operations were moving cash at high velocity during a liquidity crisis, the firm's own ability to compute, accurately and promptly, how much it held in segregation against how much it owed was degraded. The record establishes that MF Global's systems and controls were not adequate to track the firm's compliance with segregation requirements during the period of stress. Consider what would have had to be true for the system to detect the shortfall before customer money was used. The firm would have needed real-time transaction-level monitoring of every movement into and out of the segregated accounts, with an automated computation of the segregation line that updated continuously and that could halt a transfer that would breach it. That capability did not exist at the required fidelity. The control was a daily report, and a daily report cannot stop a transfer that happens at 11 in the morning and is reconciled at 6 the next evening. The third structural weakness concerned the 30.7 secured accounts, the foreign futures customer funds. The calculation methodology for the secured amount was different from domestic segregation, and the record indicates that the firm's treatment of those accounts contributed to the confusion about how much room actually existed. When you have two different protective calculations governing two different pools, and the firm is drawing on both, the margin for operational error widens. The fourth weakness was the gap between accounting reality and liquidity reality that we examined earlier. The firm's financial statements treated the European sovereign repo-to-maturity positions as sales. To an analyst or an examiner reading the financials, the firm had reduced its balance sheet exposure. But the cash demands of those positions, the margin calls, were not visible in the same way. The verification chain that focused on solvency and on the segregation snapshot was not structured to flag that a firm with an acceptable accounting picture was hemorrhaging cash through margin calls on positions it had, for accounting purposes, sold. There is a fifth point, and it concerns the velocity of the final days. The most severe transfers occurred in the last week of October 2011, with the largest movements in the final 2 or 3 days before the firm filed for bankruptcy protection. A verification system that operates on daily reporting and periodic regulatory review cannot react inside a window measured in hours. By the time the deficiency in the segregation reports was unambiguous, the firm was already in collapse and the money was already gone. This is the recurring structural lesson of customer funds protection. The legal wall is absolute. The operational wall is only as strong as the firm's own systems and the latency of the monitoring. The law says customer money may never be used for firm purposes. But the law does not physically prevent a Treasury employee from initiating a wire. What prevents the wire is a control system, and a control system that reports daily cannot stop an intraday breach. The protection was legal and after the fact. It was not operational and real-time. It is worth stating what the gatekeepers were and were not positioned to see. The designated self-regulatory organization reviewed segregation reporting and conducted examinations. But an SRO examination is periodic. It is not a continuous feed. The external auditors examined the firm's financial statements on an annual cycle with interim reviews. An annual audit cannot detect a deficiency that opens and is concealed within a single week of crisis. The CFTC received segregation data, but again, on the reporting cadence the rules required, which was daily at most for the headline numbers and far less frequent for detailed examination. For early detection to have occurred, the monitoring would have had to operate at the same velocity as the firm's treasury function. It did not. No one in the verification chain had a real-time window into the segregated accounts on October 31st. They had yesterday's numbers, and yesterday's numbers, by the end, were already wrong. Now we trace the unravelling because the collapse was rapid and the sequence is precise. By the weekend of October 29th and 30, 2011, MF Global was in negotiations to sell itself. A potential acquirer was conducting due diligence. The expectation among the firm's leadership and counterparties was that a sale would resolve the liquidity crisis by transferring the customer accounts and the firm's positions to a stronger institution. During that diligence, the acquirer's team began examining the customer-segregated accounts. Price. The deal required, as any such transaction would, that the customer-segregated funds reconcile. The buyer needed to confirm that the customer money the buyer would be assuming was actually there. And during that reconciliation, over the weekend and into Monday, October 31st, the numbers did not add up. There was a hole in the customer-segregated accounts. The firm's own personnel could not account for the difference. The record reflects that as the reconciliation proceeded, the apparent shortfall was first described as a possible error, a missing entry, a reconciliation problem that would resolve once the books were properly aligned. The assumption inside the firm was that the money was somewhere, that it had been moved to an account that simply had not been captured in the reconciliation yet. This is a critical detail of the unravelling because it explains why the firm did not immediately declare a customer shortfall. Treasury personnel believed or hoped that the gap was an accounting artifact rather than a real deficiency. It was not an accounting artifact. As the day progressed, it became clear that the money had been moved out of the customer accounts and used. The transfers were real, the deficiency was real, and the pending sale collapsed because no acquirer will assume customer accounts that are short by hundreds of millions of dollars with no clear accounting for where the money went. On October 31, 2011, MF Global Holdings filed for Chapter 11 bankruptcy protection. The broker-dealer subsidiary, MF Global Inc., was placed into liquidation under the Securities Investor Protection Act, with a SEPA trustee appointed to wind it down and to recover and return customer property. Because the firm was also an FCM, the liquidation proceeded under the special provisions governing the bankruptcy of a commodity broker, where customer property is administered as a distinct class. The scale of the shortfall was quantified through the liquidation process. The deficiency in customer accounts was established at approximately $1.6 billion. This was customer money that should have been sitting in segregated and secured accounts and was not, because it had been transferred out and used to meet the firm's own obligations during the liquidity crisis. The enforcement consequences followed through the CFTC. The Commission brought an action against MF Global and obtained a consent order. The CFTC's order found that MF Global violated the customer segregation provisions of the Commodity Exchange Act and the Commission's regulations by failing to maintain sufficient funds in segregation and by using customer funds for the firm's own purposes. The order imposed a penalty and, critically, required restitution to ensure the return of customer funds. The structure of the resolution prioritized making customers whole, consistent with the principle that the money was always theirs. The recovery process, conducted through the SEPA trustee and the bankruptcy proceedings, ultimately returned funds to customers. Over the course of the litigation and asset recovery, the trustee pursued claims against the firm's affiliates and counterparties to claw back transferred funds and to reconstitute the customer pool. The record reflects that customers of the domestic commodity accounts were, over time, made substantially whole through these recoveries. The legal characterization of the failure is important to state precisely. The CFTC's action established a violation of the segregation requirements. It established that the firm used customer money unlawfully. The mechanism of that unlawful use was not a forged document or a fabricated transaction. It was the continued movement of money out of accounts that contained customer property past the point where the firm's own excess had been exhausted, in a period when the firm's systems could not reliably tell it where the boundary was, and the firm's liquidity needs demanded the cash. The unraveling, then, was triggered not by a regulator's examination and not by an auditor's review. It was triggered by an acquirer's due diligence reconciliation, the most ordinary of commercial checks. The buyer needed to count the customer money, and when the buyer counted it, the money was not all there. That is what exposed the deficiency. The protective monitoring system did not catch the breach in time. A routine transaction reconciliation did, after the money was already gone. What does this case establish about the mechanism? It establishes that customer segregation, as a protection, operates on two distinct levels and that these levels can diverge under stress. The legal level is absolute. Customer money is held in trust, may never be used for firm purposes, and does not belong to the firm's general estate. That legal protection functioned in the end. It is why the resolution prioritized restitution and why customers were ultimately made substantially whole rather than standing in line as general creditors. But the operational level is conditional. The legal wall does not physically move money. The boundary between firm excess and customer property is defined by a calculation, and that calculation is performed by the firm's own systems on a reporting cadence. When the cadence is daily and the crisis moves in hours, the operational protection lags the legal protection. The money can be used before the system that is supposed to prevent its use even registers the breach. The MF Global case demonstrates the failure point precisely. A liquidity crisis created an overwhelming demand for cash. The largest reachable pool of cash was the customer-segregated accounts, which held both the firm's own excess and customer property in the same structure. The firm drew on that pool. The systems that defined where the firm's money ended and the customer's money began were not adequate to the velocity of the withdrawals. The firm drew past the line. The deficiency reached approximately $1.6 billion, and the legal absolute that this money could never be used was violated not through a decision to steal, but through the operational collapse of the boundary under pressure. The regulatory response addressed the operational gap directly. In the period following MF Global's failure, the CFTC strengthened the rules governing the protection and monitoring of customer funds. The Commission enhanced the requirements applicable to FCMs, including measures that came to be associated with what was described as the Enhanced Customer Protection Framework. These changes increased the frequency and rigor of segregation reporting, required FCMs to provide regulators and self-regulatory organizations with greater and more frequent visibility into customer account balances, and imposed requirements designed to prevent the kind of undetected intraday drawdown that the MF Global failure exposed. The reforms also address the treatment of the residual interest, the firm's own excess in the customer accounts, tightening the conditions under which a firm could withdraw it. The structural finding is this: the MF Global failure was not a failure of the legal principle of segregation. The principle held the money was customer property throughout, and that legal character drove the recovery. The failure was in the operational machinery that was supposed to enforce the principle in real time. A daily calculation cannot police an intraday crisis. A protection that depends on the firm's own systems to define the boundary fails precisely when the firm's systems are under the greatest stress. The reforms that followed were an attempt to close the latency between the legal wall and the operational wall, to make the monitoring move at something closer to the speed at which the money can move. The record establishes a regulated futures commission merchant, an absolute trust obligation, a liquidity crisis driven by margin calls on positions treated for accounting as already sold, a pool of customer cash sitting in the same account structure as the firm's own excess, and operational systems that could not keep the boundary precise when the cash demands accelerated. The deficiency reached approximately $1.6 billion. It was exposed not by the protective monitoring, but by an acquirer counting the money. The customers were the trust beneficiaries, and the trust, on the final day, did not hold.